Hello, and welcome to Side Hustle Ideas. I am Bill, the company's expert. Thank you for joining me today. Thank you to my YouTube channel members, my Patreons, my super thanks donors, and to all my participants. Thank you for being here. You are awesome. The title of today's episode of Side Hustle Ideas is How Investors Make Decisions. We're going to be talking about risk and return. So if you are interested in investment, you want to do it, or if you're interested at it from the other side of the table, if you are wanting to obtain investors and have them invest into something that you're doing, some kind of project that you're doing, this will hopefully help you. That's what this is for. It's also called Why We're Not Bold Anymore. This is something I wanted to talk about to lead us off. But yes, Side Hustle Ideas. This is the 61st episode of this. Can you believe this? We've been doing this for quite a while. And if you are an entrepreneur or you are someone who has ambitions to have your own business one day, to break the rat race, the cycle of employment where you work as an employee for someone else, and you want to learn how to make money yourself directly without needing an intermediary like an employer, that's what we're here to do. So thank you for joining me today. Today's actually a holiday for me in Canada, where I'm broadcasting from. It's interesting. I didn't realize it was a holiday at the time that I that I did this. This is also the beginning of a new schedule. I'm moving my live streams around, so this live stream will occur at this time every week. I'm moving it from the morning to the afternoon, just to work around some stuff I've had. But yeah, so I see there's a few people here, so thank you for joining me today. And as always, this is a Q&A. So if you are wondering anything or you are struggling with something, preferably to do with the topics that we are covering today, let me know in the chat. Get in the chat. Let me know what you're wondering, what you're struggling with, and I'll do my best to help you out. Okay. Yeah. So as I said, we're going to talk about how investors make decisions. We're going to talk about risk and return. And these are some principles, either the foundational principles of finance. So if you are looking to learn this stuff really in depth and you want to master this type of material and understand things like risk and return and how investors think, you learn this stuff in business school. And I have something that can help you right there. If you really want to go in depth, a course I have called the $100 MBA. Check it out. Link in the description. It was created for people like you, people that are looking to learn the material, but they don't necessarily have the time or inclination to go back to school and, quit work and do a full-on educational program for a couple of years. This is for those people. This information has been freely available in the public domain for a very long time, and that's what my course helps teach you. Okay, right. So the first topic of the day, I just wanted to cover this. I really don't know how to express this very well or articulate it, but it's called Why We're Not Bold Anymore. And just to sort of go on a little bit of a tangent and talk about myself for just a couple of moments here, I've always been fascinated by the history of the 20th century, in particular the world wars and things like that. Like a lot of guys, just to play the cliche, but just the socioeconomic effects of things like World War II. And what is interesting to me, anyway, is that during the World Wars, innovation really spiked. Like, they innovated more in just a couple of years than they had in several decades. In that short amount of space, in almost every facet of society, in technology and in the social structure and in politics and how things are done, organizational theory, we had a great leap forward in a very small amount of time, and I've always been fascinated by that. We've lost that. I mean, hey, maybe it's just an effect of a world war, and given the choice, I don't think any of us would want a world war. But one of the interesting and possibly good things to come out of it was the pace of innovation and the things that they achieved during that very small space of time. Now, what am I talking about specifically? I'm talking about the obvious things that people think of, things like the development of the atomic bomb. And then, after the World War led into the Cold War, you had like the space race and the Apollo program and stuff in the Cold War. They landed people on the moon, all this kind of stuff. And in the wake of the First World War, you had the Great Depression and all this kind of stuff, just major social upheaval. And things like electrification came in, right? All of a sudden we went from no electricity to electricity and things like this. So what I thought was interesting was that we developed this attitude, just humans in general, of it can be done, and think big and think bold. And they took on some incredible challenges and went for it and solved them. And I just contrast that to today, when we look at things that we're struggling with now, like a lot of the environmental stuff and a lot of the social stuff, and it's the same problems that people were talking about when I was a kid. We're still talking about today because they still haven't been solved. And you contrast that to some of these periods back in the 20th century where they just completely solved things. They went for it, Anyway, so how does this relate to side hustles and entrepreneurship? Well, a big part of entrepreneurship is innovative entrepreneurship. There are different types of entrepreneurship, as hopefully everybody knows, right? You can go the sort of traditional SME type route, and you could open a plumbing company, for example, and there's not a lot of innovation there, but you do build a business, and it is your creative vision and all this. You are in charge, right? So you can do that, but there's the tech side of innovation, where you're innovating new technologies and things. And, that's been a huge part of entrepreneurship. And for some people, that's the direction they go. They want to go down an innovative path. And I think this is a tremendous resource. And when you look at that kind of thinking, and you look at what I just mentioned, things like World War I, World War II, some of these new technologies, it's like, imagine that you had a startup idea, and unlike in this sort of climate of opinion where it's quite challenging to get investment and to get backing for it, during the World Wars, because, they were in a life and death struggle, anyone who potentially had the solution to a problem, they were generally more receptive to, and so they would back you. The likelihood that they would back you went up. And, you still got like 95% of things failing, but the 5% of things that were a success, because they were backing so many more things, you got some tremendous leaps forward that came out of it. And it must have been a very exciting time to be alive from the perspective of being an entrepreneur and getting your ideas heard. So I think that's fascinating. So I put it to you why that's no longer the case, why we no longer think like this. Once again, just to go on a personal note here for a second, where I live, they have recycling. You recycle your household trash, right? Your garbage. And, certain materials are recyclable, like cardboard and glass and all this kind of stuff. But it still amazes me that, they can't recycle things like wax paper. Like if you get a coffee cup, they still don't know apparently how to recycle that. It has to go in the trash still. And this is 20 years after, recycling became common and you actually got it rolled out to a lot of major cities and things. We still don't know how to do that, And it just seems like it's so contrary to where we were in the past, where problems like that would have been solved very, very quickly, almost overnight, because the will was there. And the money was there, and the backing was there, and the infrastructure was there, and the people that believed it could be done were there. And it seems like we really have gone away from that, unfortunately. But this is why we need entrepreneurs, because there are still tons of problems to solve, and we don't seem to be solving them at a very rapid rate. So anyone who's got some spark of genius out there that thinks they have the solution to a problem and can demonstrate it and get other people to buy into it, there's a lot of potential there, even in the current economic climate and social climate. There still is a ton of opportunity there for those of you who want to do innovative startups. Something I don't talk about very often on this channel, but it's still very, very, very useful. Okay, I'll say one more thing about this topic before I leave it, and that is the current big innovation, big trend that's sweeping a lot of elements of society is AI right now. And I think it's increasingly relevant considering that we're in this big AI wave that's coming through. And a lot of people fear it. I don't fear it. Yes, it's causing disruption. It's one of the truly disruptive things that has occurred in the last 30 years. People use the word disruptive all the time. It becomes a cliche. They keep throwing this term around, and I used to get annoyed because they kept throwing the term disruption around when things just weren't disruptive. But now we have something that's genuinely disruptive that's arrived, and people are losing their minds over it. Because they think that they're used to disruption, they think they understand it, they think they're used to it, but they're not. This is what true disruption is. Okay, let me know your thoughts on this. If you have any thoughts, get in the chat, let me know. I'd love to react to some comments and hear what you guys think. That's kind of a weird topic. I usually don't talk about stuff like this, just this nebulous general thing with no precise lesson there. But let me know what you think. I'm going to move on to the main topic of today, which is how investors make decisions. Okay, now, as I said, this is the fundamental building blocks of the study of finance. Okay, this is where we're drawing some of these principles from. And for those of you that have never studied finance, which is a lot of people, this may be new, and I hope it is, because this might shed some light on how this stuff actually works, and it may help you understand more of what you see in the real world when you try and figure out why people do the things they do. This may shed some clarity. Okay, so if you want to be an investor, or if you want to think like an investor, or understand an investor, you have to understand the concepts of risk and return. Maybe you've heard of those, right? For a lot of people, those are kind of these general nebulous kind of concepts, right? But they're actually very, very precise, and they're very mathematical. And it may seem strange to try and apply something as precise as mathematics to something as intangible as, say, a business idea that you might have, right? You might have the idea of, okay, I'm going to start this kind of business, and I don't know precisely how much money or time it will take to start it up. And then I don't know precisely how much money it will generate. I don't know how volatile that is. So with these nebulous ideas, there's not a lot of data, not a lot of precision on, it's hard to think in terms of mathematics. Excuse me. I am also sick, by the way. When I was younger, I was able to take medication and get on with it. That's what managers do. You generally, it's not a job you can call in sick to a lot of the time, depending on what you do. And so I learned early on that what successful managers did was when they had a cold or something, or they had the flu, they would take medication, they'd find out what works for them, and then they would go to work anyway, and then do their job. And I was able to do that when I was younger. And as I'm getting older, I'm finding I'm able to do that less and less. Also, the inclination isn't there. It has nothing to do with the fact that I may not be at my peak physical condition I've ever been in my entire life, but do not believe the unsubstantiated rumors that that's true. Okay, let's get back to what I was talking about here. Risk and return. So these are precise mathematical concepts, okay? Now, if you want to think like an investor, investors reduce everything to math, okay? The study of finance is basically the idea of where money is going to come from. It's about money in the future. Accounting is the study of money in the past. So if you're going to do an audit, find out where the money went, that's money in the past. Finance is money in the future. It's about what should we do? If we do this, what's the likelihood of making this much money? If we do that alternatively, what's the likelihood that that will make this much money? These kind of things. It's a different type of thing to accounting. Okay, accounting deals with precision because it's already happened. You just want to find out the facts. Finance is the business of prediction, right? Now, when you're talking about decisions of what you could do, there's all kinds of variance, shall we say. You don't know. There's uncertainty of what could happen, right? So in the study of finance, and this is how investors think, you divide it into sort of two areas. You have uncertainty, which is when you don't know what's going to happen, but there's no way to really find out. Okay, that's uncertainty. And then you have risk. Risk sounds like the same thing as uncertainty, but it isn't. Risk is where you don't know what's going to happen, but you can make a very educated prediction as to what's going to happen. Okay? Now, how do you assess uncertainty? Well, you can't. Okay? If you're just doing something new, there's just no way to find out. So finance doesn't really touch that. But as it turns out, almost everything you could do, you can look at it as a risk. And it is possible to talk about it as a risk. That means something where you get precise information on what's likely to happen. Okay, so let me give you an example. Let's say you wanted to start a business. I don't know, you want to start a recycling business. There you go. Now, you've never done this before, and you haven't started the business yet, so you have no data on how it's going to go because you haven't even started. You're right at time index 0. Okay? So how do you talk about it in a meaningful way? Because you haven't done anything, you don't know what could happen. It seems like uncertainty, right? Well, wrong. Investors, what they do is they start with what they know. Now, what you know is that other people have started recycling businesses too. And this has already occurred. And this has happened in the past. So you do have some data on how it went for them. Okay, so what you can probably find is you can find other companies that have been started in the past that were similar to the thing that you want to do, that say this happened 5 years ago, 10 years ago. So there will be data on how it went. How much did it cost to start? How much money did it make in, say, the first year, the second year, the third year? All that data is out there. Okay? So you can look at that data, and you can look at that information for many, many companies. You can group them all together. You can say, I want to look at recycling companies in this region that were small. They were started as, I don't know, 1 or 2 person companies within the last 20 years. And you can get that data and you can see, okay, on average, they cost this much to start. On average, in their first year, they made this much money. On average, in their second year, they made this much money, et cetera, et cetera, et cetera. So you can get this data, you can get these numbers. And by looking at those numbers, you can derive certain conclusions. For example, if you know that, say, 100 companies were started like that, they were in this region, they were about this size, and it was in the last 20 years, so relatively recently, okay? Let's say there were 100 companies that were started. And of those 100, 99 of them didn't make it past their first year. Okay? Just before we go any further, just take that fact. Well, that's giving you some idea of what the risk is involved if someone says, I want to start a recycling company in this region. It's going to be a small company, right? What you know historically is that 99% of those companies have failed. They didn't make it past the first 12 months. Okay, so even if you don't have any more precise data, you don't know how much it cost to start, you don't know how much money they made precisely or lost, that alone can give you an idea of the risk involved. You'd say, okay, well, without knowing anything else, I can tell you there's a 99% chance that you're going to fail within the first year, because that's the situation that's happened to everyone else who's attempted to do this. Right? Now you can go deeper and you can maybe look at the individual and say, well, this individual who's starting this company, this is maybe their first attempt at starting a company. So you have no data. So you could maybe assume they're like everyone else. Or you could say, oh, well, this person that's starting a company, say they have a track record of success. They've started 40 companies previously, and 39 of the 40 have gone on to make 10 times their original investment within 5 years. Something like that. And you look at that person's track record, and that's the result they tend to deliver. So you maybe factor that in, right? But as you can gather, you're getting information, you're getting precise data on how you can quantify the likelihood of a certain outcome. Hopefully that makes sense. Okay? So this is where we get into the idea of risk and return. Now, we've talked about risk. Risk is a number. It's a number. It's where you can say, okay, this has a certain percentage chance of working out. And return is the expected result. Okay? So risk and return, you would have an expected result. You would say, okay, we expect to make this much money in the first year, and it's 85% likely that we will achieve that. Something like that. Okay? So you assign a likelihood to an outcome. That's what risk and return is. Okay, hopefully everybody is with me so far. Yeah, and this is how you can quantify things. So this is how investors think. They think of like, what's the likelihood of a certain outcome? And the thing is, you can get this, you can calculate this with data. So if you have a company that's up and operating, the most obvious thing to do would be to look at your past history. How much money have you made every year since you started? And with that, you can drive certain conclusions. If you don't have a track record, they can look at the industry as a whole, or the industry in your region, or people in your situation. You can refine it, but one way or another, you can get data, and you can get these numbers. Now let's talk about what the numbers actually are. Okay, hopefully everybody's still with me here. My camera looks a bit weird. It's very dark in here. It's very cloudy where I am today. So hopefully this shows up okay. Right. Okay, so you can calculate this. Now, let's get into the nitty-gritty details here. There's two values that are important. The expected return, what the outcome is, and the risk, which is the likelihood that that will occur. Okay, so these are the two numbers that we're interested in. Okay, now let's make this easy. Let's pretend that you have a track record. Your company has been in business for, say, 10 years. Okay, in a perfect scenario, you'd have this kind of data. And you know how much money you made each year. Okay, so let's say, I don't know, your profit was on average $10,000 a year. Just to pick some nice round numbers here. Okay, so the average amount that you made every year over 10 years, that would be your expected value. So if one year you make 8,000, another year you make 12,000, the next year you make 9,000, the year after that you make 11,000, right? They're averaging around 10,000 a year, right? So you could say, well, if someone says to you, what do you expect this company to make at the end of this year? The way you would figure that is you average out the previous 10 years or so, all the data you have, and you say, okay, well, they seem to make $10,000 a year. So my expected outcome is $10,000 for this year. Okay. Now, what's the likelihood of that? Right? That's where it gets a bit more complicated. The expected value is very simple. It's usually an average of all your previous values. I think everyone understands that. The risk, or the likelihood that that is going to happen, is calculated by something called the variance, right? And then if you take the square root of the variance, it's called the standard deviation. Very, very mathematical way of doing this. So what that's doing is basically you're looking at ways to describe the data. Now, the average value is obviously the first way of describing the data. It makes around 10,000 a year. But think about it. You could have a very stable company that makes like literally right around 10,000 every year. 10,000 one year, 9,900 the year after, 10,100 the year after, like very, very close, right? So not a lot of variance there. Or you could have a much more volatile company that they average 10,000 a year, but it swings wildly, right? One year they make 110,000. The next year they lose 90,000, right? And then the year after that they make, 120,000. And then the year after that they lose 80,000 or something like that, right? So you see the difference. Both companies average out to 10,000 a year, but one is much more volatile than the other. Well, the way it turns out is how you measure risk is basically you look at how volatile the data has been, the historical data, okay? And you do this by calculating the variance. So I don't know if people care about this level of detail, but the variance is basically how far from the average the answer every year tends to be, right? So if the average is 10,000 a year and you're 10,100, you're very close to the average. So there's not a lot of variance. The variance is 100, right? If the average is 10,000 a year, but you made 110,000 this year, your variance is 100,000, right? It's huge, right? Huge variance. You're deviating from the average a significant amount, right? So that's what the variance is. It's how far from the average the results tend to be, okay? So anyway, it turns out that if you can calculate the average for a stream of data, a stream of numbers, and you can calculate the variance for a stream of numbers. So you got two values there, right? And then by taking the square root of the variance, you get the standard deviation. And then the standard deviation gives you a bell curve. Now let's see if I can open a window and show you guys this graphically, because I know it's a bit dry just listening to me waffle on about this. Let's see if I can pull up a bell curve. This is where I need absolute mastery over my web browser here. So here. Oh, and I prefer to go to Bing to do this, to do an image search, because for some image searches, I find Bing a little bit more user-friendly at the moment than Google. Okay, here we go. So let me see if I can share my screen here. Okay, so let's try this one here. Okay, so this is essentially a bell curve. Okay, now what they found was that for a lot of processes in nature, when you look at how things are distributed, they seem to follow the standard shape, this bell curve. Okay, it looks kind of like a bell, right? Okay, and they're using this little symbol here. You probably can't see it, or maybe you can, I'm not sure. I think that's sigma. I can't remember. I can't remember my Greek alphabet. I used to know the entire Greek alphabet, like all the different, what the letters are used for mathematically at one point. Anyway, I think this is sigma, so lowercase sigma. So this represents a standard deviation. So all it's saying is that if you've calculated the average of a string of numbers, okay, in our case, it was $10,000 a year, right? That would be right here, okay? This would be right in the middle. So your expected value for how much money you would make at the end of this year would be $10,000. But there's some uncertainty there. You know it's likely not going to be exactly $10,000. But you know it's going to be somewhere close to it, okay? That's where this bell curve comes in. Okay, so we've calculated the average, which is the expected value. We've also calculated the variance, which is on average, how far are the numbers every year away from the average? Is it just varying by a little, or does it vary by a lot? Okay, so we calculate that number, the variance, the average deviation from the average. Okay, and we get the variance. We take the square root of that number, and then we get the standard deviation. And that standard deviation will be a number, right? So in our case, our average is $10,000, and our standard deviation, let's say it turned out to be $1,000. Okay? So that means we get this result. This is the likelihood of how much money we're going to make this year. The most likely amount is right in the middle, $10,000, okay? But over here at $11,000, right? Because it's $10,000 plus one standard deviation, and in our case, our standard deviation was $1,000. Okay, if you figure between say $10,000 and $11,000, there's a 34% likelihood that our actual result will fall in that range. And same thing here, between $10,000 and $9,000, there's another 34% chance that our actual number will fall in that range. Okay, now over here at 2 standard deviations, this would be $12,000. Okay, and if we're wondering what's the likelihood that our result will fall between, say, $8,000 and $12,000, a standard deviation of $2,000, that would be down here all the way to there. Okay, it says here 95% of values are between those two values. So the likelihood of our profit this year being between $8,000 and $12,000 will be 95%. Okay, so you can read this graph for yourself. You can see how it works. But one standard deviation for us in our example was $1,000, and our average, our expected value, right here of X, is 10,000. Okay, so you can fill in all these numbers yourself, and this is the likelihood that you're going to get different values. Okay, so this is how investors think. This is what they do to try and predict the outcome of somebody running a business, somebody investing in a project or an asset, anything like that. They're calculating this. They're trying to find those two numbers. What's the expected value and what's the risk, which mathematically is the same thing as a standard deviation. Okay, you get the idea. They think in the terms of those numbers. So everything can be reduced down to thinking in terms of these two numbers. Okay, so hopefully everyone has a much easier time thinking of the expected value, which is just the average of what has happened before. Okay, the most likely thing is that you're going to get the average of a string of data, right? And in order to get that string of data, you look at historical data. You look at the track record of the company itself, and if you don't have that, the track record of the industry itself in that region, refined by factors like your geographic location and your size and your age and all that kind of stuff. Or you could even look at the track record of the individual. What's their historical data for the things they've attempted? Have on average, were they successful? On average, were they failures? And if they were successful, how successful? And how volatile is that data? And that informs you what your expected value is, your most likely outcome, and the likelihood of that occurring. And that's how you think like an investor. At its fundamental level, that's how you think like an investor. You reduce everything down to these two numbers. Hopefully that makes sense. NC Worker is here. Says, good afternoon, everyone. Good afternoon, NC Worker. Thank you for joining me today. I have 19 people here today. Okay, so just a very quick recap. If you're just joining me now, we talked about how investors make decisions. We talked about the concept of risk and return. And these are actually two numbers that you can calculate. And investors do calculate them. And in order to calculate these numbers, you need historical data. Now, if someone is proposing to start something up, they haven't started it yet, you won't have a track record of how that particular thing has gone because they haven't started it yet. But you do have historical data in some form. You have that person's previous track record. You have the thing that they're starting, that type of company or that type of adventure. You have historical data on that. So usually that looks at an industry of all the, the companies that are started or all the investments that are made in that industry, usually by location, in that region. How do they go? And you can get that data. Some companies, they will sell you that data, but that data does exist. In its absolute basic form, usually the government has that data. They collect it through taxes. When you fill out your tax return, if you have a business that's incorporated, it fills out its own tax return where it has to declare essentially its finances, how much money came in, how much money did you make, because you need that information to know how much money to pay the government in taxes, right? So they distribute this all to the government, and the government does make this available. It doesn't do it in a way that you can identify the precise company, because that would breach privacy laws. But you can go to government websites that will provide statistics on economic data. And this is freely available to the public. And they can tell you, like in a certain region, they'll either tell you this information averaged across the entire country, or they can maybe even break it down into certain regions. But they'll say, for this type of business, let's say of this size, on average, it contains this many employees, and it makes this much money every year, and here's the average, like the expected value, and here's the variance, right? So you can get this, and you can refine your query, by different factors. So if you want to know how risky certain businesses are, you can get that information from the government. Now, depending what country you're in, it's going to take different forms, but I'm in Canada. There's a website called Statistics Canada, so you can go there and get all this information free. You can contact them if you want more precise queries, and sometimes they can help you drill down into a more precise region, like a city or something like that. In the United States, they have something very, very similar. I don't remember the name of the website, but it's the U.S. government website where they make this available federally, like for the entire country. And I believe you can get it broken down by state. I think so. I'm not sure. So there you go. Now that gives you sort of a base to operate from, right? It also allows you to do research into different types of businesses to see, on average, does it make sense to do that business? Are they making a lot of money? Or are they not? Basically, it gives you all the ratios on their financial statements. So, their profit margin and, cost of goods sold and, net income and like all that kind of stuff. You can look at that averaged across many, many companies in that industry, in that situation. So that's how that stuff works. Hopefully that makes sense to everyone. Now, this is kind of the tip of the iceberg. I'm sort of trying to explain this without drawing it out, without showing you any equations or anything like that. I'm just trying to do this all verbally. So there's a limit to what you can do verbally, unless I want to try and teach a lecture on it. But that's the basics. You can go a lot deeper than this. You can go into diversification and market risk and all this kind of stuff. Let me know if you want me to go in that direction. I could go there if people want me to, but I think this is the basics, and this is what everyone needs to know. If you do want to go further, consider getting a book on finance. And once again, if you do want to go deeper, I've created this resource for people. Check that out. That's the best bang for the buck you're going to find anywhere, where it's called a course because it's technically a course, but it's actually taking you through everything and in an entire business program. That's many courses. Okay, there's a link in the description if you want to check it out. There's a lot there. And even if you just are interested in the finance component of it, you don't care about marketing or HR or anything like that, check that out still. That's definitely worth the bang for the buck, what you're getting for what you're paying. And you're getting the definitive information on how this stuff works from beginning to end. And you can go as deep as you want. So that's what I'd recommend. Okay, I'm going to open this up to questions. So if anyone has any questions about this or anything to do with entrepreneurship or business, speak now or forever hold your peace. Get in the chat. Let me know what you're wondering about and what you're struggling, what you're trying to do, and maybe what you feel is stopping you or puzzling you at the moment. And I will do my best to help you out. Yes. In the meantime, later this afternoon, I am doing a collaborative live stream with, I believe it's Abby from the YouTube channel Life Work Balance. Abby is a recruiter, and we're going to be talking about, how to get a job and how to pass a job interview and that kind of stuff. So if you're interested in that, stick around. I'm going to be doing these more on this channel. I'd like to do one weekly where I talk to other YouTubers that are in the similar space to me, talking about employment and hiring and all this kind of stuff. I'd like to do one with business people too. Just be able to put questions to them, and you can get different perspectives on things, and you can maybe see where everybody's coming from, and that helps inform people further. Okay, not a lot of questions. As I said, today is a holiday, so I didn't realize that when I had scheduled this a few weeks in advance. So yeah. But yeah, if I don't get a question in the next 30 seconds or so, I'll probably be wrapping it up. But yeah, you can learn more about this. Once you understand how investors think, that helps you to understand what is a good investment. And what is a good investment translates to whether it's likely to succeed or not. And understanding that is very important to make the right decisions as to what business to start up and how to do it and increase your chances of success. Okay, a lot of entrepreneurs, they don't really understand investors. And in my experience, neither really has a complete picture of how things go and what's really going on. But the more you understand about, how you can look at what you're doing, the prospect of starting a business, whether it's a side hustle or it's a full-blown business that replaces your day job or equivalent, you want to give yourself the best likelihood of succeeding. And so it's good to look at it from many different perspectives and avoid pitfalls and spot trouble, and realize why things are considered higher risk or not, right? That only serves to make you more successful in the long run. Okay, so it looks like we're going to wrap this up early today. Thank you for joining me. You guys are awesome. I do this stream every week. So let me know if you have any questions about this kind of thing. Check out my course for the $100 MBA. And you take that course. If you are looking to start a business, you're looking to do a side hustle, for $100, this will give you so much value. You'll be able to avoid very costly mistakes. You'll be able to achieve success years ahead of the time you would have if you didn't know business. Absolutely incredible. And I created this course for anybody who's looking to learn business. And you get not only the business theory, you also get many videos from me that give you my perspective, having been an entrepreneur, having been a CEO of a smaller company. You get my take on a lot of the material, how it relates, how you can use it. Check that out. Okay. Hello to Quanel. Is that how you say that? Thank you for being here. Quanell, so sorry for arriving late. I will rewatch the live. Yes, well, thank you for being here, Quanell. And when you rewatch the live, what I like to do with a lot of live streams and stuff that I've seen from other people is watch it at like 1.5 times the speed, and it flows a lot better, and it's a little bit more interesting. Okay, so thank you very much. I will be back a week from today at the same time with another episode of Side Hustle Ideas. I will also be back in an hour and 15 minutes for a collaborative live stream right here on this channel with another YouTuber talking about virtual job interviews. So join me for that if you are interested. Until then, take care. You guys are awesome. I wish you nothing but success.